Welcome to the final stage of our financial literacy web series. In this episode, we synthesize everything from stages 1 through 3 into a unified, actionable framework for wealth creation. This is designed for learners who are ready to think independently and build financial lives that compound with intention. The journey to mastery is not just about knowing individual concepts like budgeting or investing, but understanding how they connect into a coherent system. As we move forward, you'll discover how to operate this system consistently over decades, turning knowledge into lasting financial security. Let's begin by exploring the complete wealth-building framework. Wealth is not a destination. It's the cumulative output of a system you design, refine, and operate over time. In previous stages, you learned about budgeting, debt management, asset classes, and behavioral traps. Now, stage 4 asks a new question. How do all these pieces connect into one machine for long-term financial growth? The core equation is simple yet powerful. Wealth equals income multiplied by saving rate, invested at a return rate over time. Notice wealth does not equal income alone. Many high earners remain financially vulnerable because they allocate little to productive assets. Conversely, a disciplined saver on a moderate salary can build profound security. The four variables are interdependent, and time is the most critical, rewarding those who start early and remain patient. One of the most important distinctions in financial literacy is between income generation and wealth creation. Income generation is exchanging time, skill, or capital for money in the present. Think salary, freelance fees, or consulting. It stops when you stop working. Wealth creation, on the other hand, is converting a portion of that income into assets that produce future income, independent of your ongoing labor. The transition happens through systematic conversion of earned income into investable assets before lifestyle absorbs them. This is the foundation for building lasting wealth, and understanding this distinction is key to financial mastery. Willpower is a finite resource. Financial discipline based solely on willpower often fails during stress, market volatility, or major life events. Sustainable wealth creation depends on automating critical decisions, automatic investment contributions, debt repayments, and portfolio rebalancing. This way, your financial system operates independently of your emotional state. Discipline is not about motivation. It's about having systems that act even when motivation is absent. The wealthiest individuals are usually those who built and faithfully operated a financial system over decades, letting compounding work quietly in the background. Financial habits operate below conscious decision-making. Every time you automatically invest before spending, review your portfolio at a fixed interval, or assess a major purchase against your long-term goals, you're executing habits that compound in value over years. The goal of financial literacy is to internalize these habits so thoroughly that sound financial behavior requires little active thought. Modest income, high saving rate, disciplined investing, and decades of patience will build more wealth than an inconsistent approach to a large income. The system is the strategy. Financial independence is not about wealth for its own sake. It's about acquiring sufficient assets so that work becomes a choice, not an obligation. Financial independence is reached when your passive and investment income covers your essential living expenses without requiring active employment. This milestone is calculable and gives your financial journey a clear compass. Path to independence is the gradual migration from dependence on active income to sufficiency from passive income, achieved through patient accumulation of productive assets like equity portfolios, business ownership, or rental property. All income falls into two categories, active and passive. Active income comes from your time and effort, capped by hours in a day and stops if you stop working. Passive income comes from assets you own, scales with capital deployed, and continues even if you stop working. The journey to financial independence is about gradually shifting from active to passive income. This happens through accumulating productive assets until your passive income stream is self-sustaining, freeing you from the need to work for money. Financial freedom is broader than independence. Independence is a number, the point at which assets cover expenses. Freedom is a design, the life you choose once financial constraint is no longer dominant. It might mean continuing to work because you value it, starting a project with uncertain returns, retiring early, or changing careers without income anxiety. The common thread is decision autonomy, the ability to make choices based on preference and values, not financial necessity. Intentional lifestyle design, calibrating spending to your values, increases saving rate and accelerates independence. Journey to financial independence can be visualized as a ladder with 5 rungs. Financial security, emergency fund, no high-interest debt. Financial stability, expenses covered, consistent investing, adequate insurance. Financial flexibility, investment income contributes to expenses. Financial independence, passive income fully covers living expenses. And financial freedom, assets exceed independence threshold, lifestyle fully self-directed. Most people stay between the first 2 rungs, not because the ladder is inaccessible, but because they never consciously decide to climb it. Financial literacy is the decision to climb deliberately. Portfolio is not a collection of bets. It's a structured, long-duration machine for growing and preserving capital. Professional portfolio thinking goes beyond asset selection. It includes allocation across risk classes, systematic adjustment over lifetime, diversification, and psychological discipline to maintain course through market cycles. Asset allocation is the most significant determinant of long-term outcomes, evolving as your time horizon shortens and risk tolerance changes. The art of portfolio strategy is calibrating this balance throughout your life. Asset allocation changes with life stages. Early career favors aggressive accumulation with high equity weight. Mid-career shifts toward capital protection. Pre-retirement balances growth with drawdown protection, and retirement focuses on income generation and capital preservation. These ranges are illustrative. Individual circumstances shape allocation more precisely. Equities provide growth but require time to absorb volatility, while defensive assets provide stability but constrain long-term returns. Calibrating this balance is key to portfolio longevity. Compounding operates silently and exponentially. Early contributions to a long-duration portfolio carry disproportionate weight because they have the most time to compound. A contribution made at age 25 has 3 times the compounding runway as one made at age 45. This places enormous strategic value on starting early, contributing consistently, and avoiding disruption. Disrupting compounding for short-term convenience is one of the most expensive financial decisions, with costs accumulating silently for decades. Portfolio designed only to grow is incomplete. Portfolio longevity requires managing 3 specific risks. Sequence of returns risk. Poor returns early in drawdown are disproportionately damaging. Inflation risk. Inflation erodes purchasing power. And concentration risk. Overexposure creates fragility. Diversification is not timidity, it's structural acknowledgement of uncertainty. Managing these risks ensures your portfolio lasts and supports your financial goals throughout life. Markets cycle through expansion and contraction. Bull markets generate optimism. Bear markets generate fear. The consistent investor maintains contributions and strategy through both phases, understanding that volatility is the price of long-term equity returns. Historical evidence shows that time in the market, not timing the market, determines outcomes for long-term investors. Consistency is the competitive advantage available to every individual investor. Experienced investors don't eliminate risk. They understand it, price it correctly, and structure decisions so no single mistake is catastrophic. Risk refers to situations where outcomes are knowable and probabilities can be assigned. Uncertainty refers to situations where outcomes are not fully known and probabilities cannot be reliably assigned. Most real financial decisions involve uncertainty. Mature investors acknowledge what is and isn't knowable, building portfolios that survive a wide range of outcomes. Sound financial decision-making is probabilistic, not deterministic. Rather than asking, will this work? Disciplined investors ask, across a range of plausible outcomes, what is the expected value and what is the worst case I must survive? This reframing shifts focus from prediction to preparation and structure. Probabilistic thinking guards against hindsight bias and helps evaluate decisions by their quality at the time, not just their outcome. Margin of safety is a principle in investment philosophy. Build a buffer between your assumptions and the point at which a decision fails. If an investment requires a high return to justify its price and your best estimate is lower, you have no margin of safety. The margin of safety is not pessimism, it's intellectual honesty about the gap between your knowledge and the complexity of the world. It protects against analytical error, unforeseen events, and market volatility. Protecting capital is as important as growing it. The mathematics of loss are brutal. A 50% decline requires a 100% gain to return to the starting point. Avoiding large losses is often more valuable than achieving large gains. Capital preservation and growth are complementary objectives, weighted differently at different stages of wealth accumulation. Managing risk and avoiding catastrophic mistakes is essential to long-term success. Human brain is poorly equipped for long-term financial decision-making. We are wired for loss aversion, recency bias, and overconfidence. These tendencies are not character flaws, they are evolutionary features, but they are devastating in financial markets, which reward patience and punish reactivity. The most expensive financial decisions are almost always emotional ones. Process, structure, and pre-committed rules are the best defenses against emotional decision-making. Single income source is a single point of failure. Financial resilience is built on diversity, across income types, skills, and asset classes. The conventional career model of one employer and one salary is outdated. Building multiple income sources is not a luxury. It's a fundamental risk management strategy available at every income level. Developing at least one income stream beyond primary employment is practical and increases financial security. Income sources range from primary employment, most reliable, least scalable, skill-based secondary income, consulting, freelancing, business income, scalable, higher risk, investment income, dividends, interest, capital gains, to passive income, rental, royalties, digital products. Most people won't operate all 5 categories, but developing at least one secondary stream is achievable and valuable. Building systematically from there as capacity and capital grow is the goal. Skills are the most liquid and portable form of capital. Unlike financial capital, skills can't be inflated away, taxed directly, or lost in a market downturn. Investing in skill development generates compounding returns over a career, higher income, expanded opportunities, and optionality. The most financially mobile individuals continuously expand their skill set in response to market demand, keeping their earning potential growing independently of any single employer. Saving rate and return rate are important, but there's a ceiling on how much you can save from a fixed income. There's no structural ceiling on earning growth. Deliberate investment in professional development, relationship building, and value creation can substantially expand the income available for wealth creation. Earning more and investing efficiently are multiplicative strategies, not just additive. Tax efficiency is not a marginal consideration. Over decades, the difference between tax-optimized and tax-indifferent investing can amount to years of additional financial independence. The compounding effect is indifferent to whether friction comes from poor investment selection, high fees, or avoidable taxation. Optimizing for friction is as important as selecting the right assets. The tax efficiency mindset asks, am I holding this in the most tax-efficient structure available? Consider the compounding mathematics of a 1% annual cost difference on a long-duration portfolio. Over 30 years, a portfolio generating 10% gross annual return retains about 57% more ending value at a 0.1% total cost than at 1.1%. This is not a marginal difference. It's the difference between financial independence and near independence. The same logic applies to taxation on returns. Holding equity positions through natural business cycles benefits from preferential tax treatment. Investment costs manifest in several forms: expense ratios, brokerage commissions, currency conversion spreads, platform fees, advisor charges, and bid-ask spreads. Each is a silent tax on returns. The informed investor asks, what is the total cost of ownership, and am I receiving commensurate value for it? Prefer low-cost index instruments where active management does not add value, utilize tax-advantaged accounts, and minimize unnecessary portfolio turnover. You cannot control market returns, but you can control costs, taxes, and structure. In the long run, discipline applied to these controllable factors is more reliably predictive of outcomes than any forecasting ability. Optimizing for what you can control is a core principle of financial mastery. Understanding what builds wealth is only half the discipline. Understanding and actively avoiding what destroys it is equally critical. Wealth is fragile. Decades of accumulation can be reversed by a few structural mistakes. Common wealth destroyers include lifestyle inflation, high-interest debt, inconsistent investing, overtrading, speculative behavior, lack of patience, lack of diversification, and emotional investing. Each represents a failure of sustainability. Allowing spending to rise proportionally with income is a common trap. Earning more but saving the same percentage means every income increase is absorbed by lifestyle, leaving the saving rate static and the wealth creation engine unchanged. Avoiding lifestyle inflation is essential for building wealth. Consumer credit used for depreciating assets or ongoing consumption is a wealth destroyer. A 24% annual interest rate demands extraordinary investment returns just to break even, returns that are not reliably available in any market. Avoiding high-interest debt is critical to financial health. Consistent investing, delayed contributions, and arbitrary suspension of savings plans are invisible wealth destroyers. Compounding is unforgiving of gaps. The cumulative opportunity cost of financial inconsistency is enormous and often invisible until it's too late to recover. Excessive buying and selling, driven by the illusion of superior timing, and allocating meaningful capital to highly uncertain, momentum-driven instruments are destructive. Every transaction carries costs, generates tax events, and dilutes compounding. Most active traders underperform passive, low-cost approaches over time. Withdrawing from investments during market downturns or abandoning a sound strategy because it hasn't produced returns on an expected timetable is a category error. Wealth creation operates on decadal timescales, not quarterly ones. Patience is essential for compounding to work. Concentration in a single stock, sector, asset class, or geography increases risk. Diversification is free insurance against the reality that individual predictions fail. Emotional investing, buying at euphoric peaks and selling at despairing troughs, is the inverse of rational strategy and leads to underperformance. Common thread across all wealth destroyers is a failure of sustainability. Each provides a short-term benefit at the cost of long-term financial integrity. Ask, is this sustainable over a 20-year horizon? If not, the decision deserves serious scrutiny. Avoiding critical mistakes is more important than making brilliant decisions. Blueprint is a structured framework guiding consistent action across time. The 9-step personal wealth blueprint synthesizes every concept into an ordered, actionable sequence. These steps are layered and concurrent, each remains relevant as you advance. The blueprint adapts to life changes, ensuring your financial plan remains robust and flexible. 3 to 6 months of essential expenses held in liquid, low-risk instruments is the foundation of all financial planning. Without it, unexpected events force unwanted asset liquidation or high-cost borrowing, disrupting your strategy. Establish this before any discretionary investing. Life, health, disability, and property insurance are risk transfer mechanisms. Adequate coverage ensures that catastrophic life events don't become catastrophic financial ones. Underinsurance is a structural vulnerability in any financial plan. Establish a systematic investment contribution, a fixed amount or percentage of income directed to long-term instruments at a regular frequency, independent of market conditions. Automate it. Consistency and compounding over time are the foundation of all long-term wealth creation. Distribute investment capital across asset classes, geographies, and instruments. Diversification reduces portfolio volatility without proportionately reducing expected returns. It's the one genuinely free lunch available to investors. Understand your actual risk exposure at all times. Review concentration risks, liability mismatches, and leverage positions. Ensure no single position or event can permanently damage the portfolio. Apply position sizing discipline based on confidence and evidence. Hold investments in tax-advantaged structures to the maximum extent available. Favor long-term holding periods for equity positions. Select low-cost index instruments where active management does not justify fees. Review the total cost of each investment annually. Conduct a structured portfolio review at least annually and after any major life event. Rebalance to target allocation if drift has occurred. Confirm insurance coverage remains adequate. Verify that your financial plan still reflects your current life circumstances and goals. Periodic review prevents silent drift from strategy. Invest continuously in professional skills, domain expertise, and income-generating capabilities. Seek and develop secondary income streams over time. Increasing the income available for investment is, at earlier career stages, the highest leverage action for accelerating wealth creation. Commit regularly to the long-term framework. Resist short-termism from financial media, social comparison, and market noise. The investor who maintains disciplined process through bull and bear markets accumulates advantages that cannot be replicated through smarter picking or better timing. The blueprint is a living document, adapting to life changes while maintaining core principles.